Everybody has heard about Bitcoin and other cryptocurrencies, but most people don't understand the law or the lack thereof surrounding these currencies. And it can lead to you getting taken advantage of by unscrupulous vendors. So how do you protect yourself? Well, you're about to find out. I'm Joshua Roberts, attorney at law, and you are watching Lawyer Up. In today's episode, we're going to talk about what cryptocurrency is and the blockchain technology behind it. Then we're going to talk about the different cryptocurrencies that are out there and how to buy them. We're going to talk about the legalities of cryptocurrency and the scams that are being perpetrated that you need to avoid. And last but not least, we're going to talk about some other things to think about before you buy into cryptocurrency. If you like the episode, hit that like button for me. If you got something to say, put it in the comment sections below. If you haven't subscribed, do so. Hit that button and hit that bell so that you get notified when we upload. And remember that we're available on all major podcast outlets. So let's talk about cryptocurrency. And remember, I'm a lawyer. I'm not a tech geek, so I don't dive very deep into the explanations of the currency or the blockchain technology. I'm more of an expert on the law. But for those of you that aren't familiar with some of the specifics, we're going to talk about the basics of cryptocurrency. And number one, what is cryptocurrency? Well, it is a form of currency or payment that can be exchanged online for goods or services. It's that simple. Now, the word cryptocurrency is somewhat new, but the concept is not. Lots of companies have issued their own currencies, often called tokens, that can be traded usually for the good or the service that that company provides. The most common are with arcade tokens or casino chips. You'll exchange real currency for the token currency to gain access to a specific good or service, like say an arcade game or a blackjack table. Cryptocurrencies are a little different because it's on the web and you can use them to buy virtually anything. And it works using what's called blockchain technology. What is that, you ask? Blockchain is a trendy name for what is called distributed ledger technology, or DLT. So a blockchain is a public digital ledger of transactions that records information in a way that makes it difficult to hack or to alter. The technology allows a secure way for individuals to deal directly with each other without needing an intermediary to guarantee payment like, say, a bank. It's probably easiest to just think of a traditional checkbook or a QuickBooks ledger. Each row contains transactional information like the date, the amount, the payee, and the data set is referred to as a block. Each transaction or block is then independently verified by a computer network, time-stamped, and added to a growing chain of data. So once recorded, this data cannot be altered, and it's kind of final and forever, and it's set. And when you string a series of these blocks or transactions together, they are chained, hence the name blockchain. So here's just a quick example using the Bitcoin system to kind of explain how blockchain works. So you purchase a certain amount of Bitcoin. The purchase is entered and transmitted to a network of thousands of computers around the world known as nodes, N-O-D-E-S. This network of nodes then compete to confirm this transaction using computer algorithms. This is known as Bitcoin mining. So the miner who first successfully confirms the transaction and completes a new block is rewarded with payment for their work. Usually in Bitcoin. It's like a transaction fee. After your purchase is cryptographically confirmed, the sale is then added to a block on the distributed ledger. Then the nodes of this computer network must affirm the block in a process known as proof of work. And once that happens, the block is permanently chained to all of the previous blocks on the Bitcoin transactions using the cryptographic fingerprint known as a hash. And the sale is complete. And so that explanation is super simple for people who understand it and super complicated for old people like me. But that's the simple explanation of the blockchain. And while it was popularized by the growing use of Bitcoin and other cryptocurrencies, a new generation of blockchain technology has been developed for use in the legal, real estate, banking, gambling, and medical fields. So that's basically blockchain. So let's get back to the cryptocurrencies. The next question is, how many cryptocurrencies are out there? According to coinmarketcap.com, a market research website, there are currently more than 10,000 different cryptocurrencies. The total value of all cryptocurrencies in July of 2021 was more than 1.3 trillion. But note, that was down $1 trillion from just 3 months earlier. The total value was cut in half from its April high of 2.5 trillion to the end of July. Now that is volatile. Remember that. And even though there are 10,000 cryptocurrencies, Bitcoin and Ethereum alone have more market capitalization than all of the other cryptocurrencies combined. So those are the two big boys. So why are cryptocurrencies so popular? Well, they appeal to their supporters in a variety of ways. And some of the most popular are that supporters see cryptocurrencies such as Bitcoin as the currency of the future. They believe it will ultimately replace traditional currencies such as the dollar or the euro. So they are racing to buy Bitcoin now, presumably before they become more important and valuable. Other supporters like the technology behind cryptocurrencies, the blockchain, right? Because its processing and recording can be more secure than a traditional payment system. Other speculators like cryptocurrencies simply because the value seems to be going up. These people really have no interest in the currency's long-term acceptance as a way to move money or the security aspects of the transactions. They just want to make some money on it, right? So a lot of people ask, will cryptocurrencies be the currency of the future? Well, it's way too early to tell. For those who see cryptocurrencies such as Bitcoin as that future currency, it should be noted that currencies need stability so that merchants and consumers can determine what is a fair price for a good. If I pay let's say a token for a sandwich today, I don't want to pay 2 tokens for the same sandwich tomorrow. I want my currency to be stable. And as I stated, Bitcoin and other cryptocurrencies have been anything but stable throughout much of their history. For example, Bitcoin traded at close to $20,000 in December of 2017. Its value then dropped to as low as $3,200 a year later, but by December of 2020, it was trading at record levels again. That price volatility makes cryptocurrencies a less viable future currency to replace, say, the dollar or the yen or any other currency. The next question that's been asked a lot is, how do I buy cryptocurrency? And to buy cryptocurrencies, you'll need a wallet and an online app that will hold your online currency, right? Generally, you create an account or an exchange, and then you can transfer real money into your wallet to buy cryptocurrencies such as Bitcoin or Ethereum. Coinbase is one popular cryptocurrency trading exchange where you can create both a wallet and buy and sell cryptocurrencies. And a growing number of online brokers offer cryptocurrency trades such as eToro, TradeStation, Robinhood, Binance.us, and Gemini. So it's pretty easy to get started if that's what you choose to do. Now let's move to the legal aspect of things. And people ask, are cryptocurrencies legal? And the answer to that depends. They're legal in the United States, but China has essentially banned their use. So ultimately, whether it's legal or not depends upon each individual country. And although it's legal in the United States, cryptocurrency is an unregulated industry. So it is the wild, wild west out there. So don't expect the sheriff to roll into town and round up the bad guys if you get ripped off by fraudsters who see cryptocurrencies as an opportunity to bilk investors. And they do. The pump and dump scheme by celebrities and YouTube personalities is a current fraudulent ruse that has snared many a new Bitcoin speculator. And we're going to talk more about that here in just a minute. So the next question is, why isn't cryptocurrency a regulated industry in the United States? And we start with the proposition that a lot of people just assume that cryptocurrency is regulated by the government and specifically by the Securities Exchange Commission or the SEC. A lot of people assume it's just like a mutual fund or a stock or a bond and it's regulated. Well, it's not. So the SEC regulates investment contracts, not currency. And the United States Supreme Court defined what is and what is not an investment contract back in 1946 in the case of the Securities Exchange Commission versus W.J. Howey and Company. And that's where it developed what we refer to as the Howey test. So the Supreme Court said this is how we going to determine what an investment contract is. And that's as good as the jokes are going to get. In this one, folks, I don't have a lot of securities related material. Sorry. So in Howey, the court defined an investment contract as, quote, an investment of money in a common enterprise with a reasonable expectation of profits to be derived from the efforts of others. And that's the important part, to be derived from the efforts of others. Let's look at an example. So I buy stock in Ford Motor Company. It fits the definition. I'm investing my money in that business, hoping to make a profit from the efforts of employees of Ford Motor Company, right? Different example. I buy Bitcoin. Bitcoin does not fit the definition because profits are not derived from the efforts of others. I'm not an owner in that company of Bitcoin. I just own the token or the currency or the Bitcoin itself. Now, here's one side note. While Bitcoin clearly is not an investment contract, there are some new cryptocurrencies that when you buy part of their cryptocurrencies, you become a fractional owner in the company itself. And these technically would become investment contracts that could be regulated by the SEC. But the SEC itself has said that regulating cryptocurrency is not a pressing concern to them at this time. And that distinction is important because the SEC regulates unfair trade practices within the securities industry. An example would be insider trading and actions and statements by insiders of publicly traded entities. Now, insiders are those officers, directors, and other high-ranking officials within the business, as well as anyone owning more than a 10% beneficial interest of ownership in the business. What they say and do is highly regulated, and it should be. So if an insider, say, owns 20% of a business and they know that a new product that's supposed to be released at the end of the month actually doesn't work, he shouldn't get to sell all of his stock prior to the news going public to all of the other shareholders so that he avoids the inevitable decrease of that stock's price that is coming, right? Likewise, an insider can't say, man, we're making so much money, you'd be crazy not to invest in my company, in an effort to try to artificially boost that stock's value. Now, Elon Musk is constantly in hot water for tweets about Tesla's financial condition, their production volume, and new product lines. Now, you and I, we can talk publicly about Tesla because we're not insiders, right? But insiders have rules they have to follow about making such disclosures. These rules do not apply to cryptocurrencies, right? Remember that. So what some unscrupulous people are doing is they are resurrecting old investment schemes that were ultimately outlawed by the SEC. And the main one right now is the pump and dump scam. So what is the pump and dump scheme, right? This is basically when someone tries to boost the value of an investment, such as a cryptocurrency, by generating real or even fake buzz or news around it, right? Hey, you need to buy this cryptocurrency. It's going to be the wave of the future. And when it replaces the dollar, you're going to be thankful that you bought it when it was cheap. We're all going to be rich, right? You hear these types of things. That is totally illegal for an insider to say in, say, stock market world. But it is totally legal in the world of cryptocurrency. And that is exactly what several new cryptocurrencies are doing by using celebrities and YouTube influencers to stoke the buy-in. And here's how the scam works. Let's say I'm an original owner of Lawyer Up cryptocurrency, and I have 1,000 crypto coins worth, let's say, $1 a coin. And there are only 500,000 coins available total. So like anything else, there is a finite supply. So if a YouTuber or a celebrity can get a buying frenzy started, demand will outpace supply and the value per coin will go up. So let's say that happens. Now my crypto coin is worth $10 a coin. So that's the pump. We have pumped up the cryptocurrency's value. Now, I have no intention of Lawyer Up becoming the cryptocurrency of the future, right? We're not going to be able to compete with Bitcoin, who is way, way ahead. But who cares, right? I just made $900,000. So I'm good. So once the pump is over, then I dump. I sell all my coins, and with the flood of the coin supply, the bottom drops out and the price plummets. And guess where all of that money that I just made came from? The purchaser who bought my crypto coin for, say, $5 a coin, and now after the dump, it's worth 10 cents a coin. And it's legal. At least it doesn't violate SEC rules. Now, it still may be fraud if the government can prove it and if it's based in the United States for United States prosecution, but most of these pump and dump schemes are based somewhere else. So be very wary of non-financial influencers who are promoting cryptocurrencies. Because we know Kim Kardashian is doing it. FaZe members are being kicked out of FaZe Clan for promoting these pump and dump schemes. Logan Paul is promoting his new Dink Doink cryptocurrency, and all of his friends are currently pumping this coin. He's an owner, so be wary and wait and watch for the dump. So these celebrities and influencers, they're in on it, right? That's how they get paid. An Aiden Ross video stated he was being paid over $1 million to promote a coin. He even made the statement that it was a scam and he hoped that his fans didn't fall for it. Nelk has said this about influencers promoting coins and other gambling sites. Quote, every influencer you see promoting any coin or crypto has a very simple goal. Get their fans to invest their money because they receive free coin or they bought very low. When you all trust them and invest, they sell and make tons of money off you. It's effing disgusting and don't fall for it. So pay attention. Obviously, these fringe pump and dump cryptos are bad news. But are there legitimate cryptocurrencies that are a good investment? That's the final question for the day. First, as stated, legally they aren't investments at all. But if you buy low and you sell high, you can make money on them. As far as a long-term money maker, it's yet to be determined, but if the 2021 50% drop in value tells you anything, then it's not a safe long-term investment at this time. So compare it to a traditional stock in a well-managed business, which increases its value over time by growing profitability, by improving operations or expansion of product lines or whatever, right? When you own stock, the investment grows as the company grows. With cryptocurrencies, while they do fluctuate in value, you don't own anything other than the token itself, right? You don't own a percentage of the business. So just like any other currency, say a dollar or the yen, cryptocurrencies generate no cash flow. So a $10 bill will still be worth $10 10 years from now, right? So for you to profit from a currency, someone has to pay more for the exact same token marker than you did. And this is referred to as the greater fool theory, right? You need somebody more foolish than you to buy your currency, your $10 bill, for more than $10. That seems iffy as a long-term investment strategy. Some notable voices in the investment community have advised would-be investors to steer clear of cryptocurrencies. Warren Buffett compared Bitcoin to paper checks. He said, quote, it's a very effective way of transmitting money and you can do it anonymously and all that. A check is a way of transmitting money too, but are checks in and of themselves worth anything just because they can transmit money? Well, no, Mr. Buffett, they are not. So that's the episode. I hope you have enjoyed it. We have talked about what cryptocurrency is and what blockchain technology is. We've talked about the different types of cryptocurrencies that are out there and how to buy them. And we got into the legalities of cryptocurrencies and the scams that you should avoid to protect your money. Finally, we talked about other things you need to consider before you go into the cryptocurrency world. And if you have enjoyed this episode, smash that like button for me. I would appreciate it. If you got a comment or a question, put it in the comment section below. If you have not subscribed to the channel, what are you waiting for? Do that. And as you guys know, I love it when you share me on social media. Again, I'm Joshua Roberts, attorney at law, and you've been watching Lawyer Up.
Send lawyers, guns, and money. Dad, get me out of this.